What happens if your house does not appraise? This could be for a purchase, this could be a refinance. We're going to talk about the details and what you need to know if you fall into this scenario. And by the way, bonus tip, we are in 2024 and this is happening more than you think. So make sure and put your belt on, strap in, let's go. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates, and we are here to help home buyers make smart financing decisions. So today we're talking about if a house does not appraise. And so we definitely need to have a specific scenario. But what I want you to take away is this kind of policy or quote to start with. And the lender, the bank, the lender, the person giving the money, 99.9% of the time, is going to give you a loan based on the lesser of the purchase price or the appraised value. Now, I'm going to go through the math of what that actually means, but I'll say it again because this is important, is the lender is going to give you a loan based on the lesser of the purchase price or appraised value. Now, I will underscore that the lender will give you a loan is the start of that sentence. So just because it doesn't appraise does not mean the deal falls through and is canceled and is dead on arrival. So what does that mean? I'm going to bring up on the screen here and we're going to talk about next. We're going to talk about an example here of a list price of $400,000. In this scenario, and this is very, very recent and very current and very real, but this $400,000 property had 10 offers. Now, the winning bid for this property was $500,000, right? So they paid way over asking price. And to be honest, the list agent probably put it low to really drum up a lot of additional offers, knowing this is a seller's market. So the winning bid was $500,000, but the appraisal comes in at $450,000. So here's your scenario. In this case, if the buyer was putting 20% down, in reality, or at the beginning, $500,000, 20% down, they would have had a $400,000 loan, right? So you with me so far? Now, it appraises for $450,000. And as I shared with you, the lesser of the purchase price or appraised value. So therefore, $450,000 times that 20% down payment, as you can see here, that's $90,000. That's your down payment now, right, for a $450,000 purchase. And if you take that $90,000, subtract it from the $450,000 that it appraised for, that's $360,000. So if you still purchase it at $500,000, your loan amount is $360,000. That means your down payment is $140,000. You're picking up $40,000 of additional cash to close. All right? So let me take this off the screen and explain why someone might do that. In a super competitive market, this might be the only way to make it work, right? This very well might be, you might have to just understand that this is your only opportunity to be in quote unquote this neighborhood or where you want to be or down the street from family. Maybe that's very important to you. So you feel like, yes, there's good value. It's a long-term home. I'm okay paying $500,000, even though right now the comparables show it's $450,000. Now, because you're putting 20% down, that would be your portion. Whenever you have a shortage, the bank is picking up basically your down payment percentage, which is 20% down. If you noticed, you went from 100 to 140, even though there's there's a $50,000 difference. The bank would be picking up the financing, the $10K, and you'd be bringing in the $40K or 80%. So if you notice, that kind of flip flops. If you didn't follow me there, there's a $50,000 shortage. 80% of that shortage is $40,000. That's the same percentage of loan to value that you were planning to bring in at the beginning. That is not irony. That is just math. That's how it works out, right? So you're putting 20% down. Well, when you have a shortage, the bank picks up, right, that 20%, you're picking up the 80. The same would go as if you were putting 10% down, the bank would only pick up 10% and you'd be on the hook for 90%. So in this case, the transaction can move forward. Hopefully the math didn't scare you there. Again, it's just math. But here's some other alternatives that could come into play. Number one, you could go back to the seller and say, hey, this did not appraise. It appraised for 450, not 500. Bring your price down to 450, or I'm going to cancel the transaction. There's potential in some markets that's fair. Hey, they'll come down. They got more than what they're expecting. They want to close with you. Maybe you were the only offer. Maybe you were by far the best offer, whatever. But they can come down to that. You can renegotiate the contract at that point. Number two, you could split the difference. You can now revise the purchase price to $475,000, meaning that you would only be bringing in a smaller portion of money, but you come down to $475 and say, okay, I'm willing to move forward at $475. Or, as I showed you on the math here, and I'll bring it back up one more time, is that your cash to close of $100,000 moved up to $140. Now, what I want you to consider here is that the $140, or that extra $40,000, that is not necessarily a fee, right? Or just going into, anywhere. It's not going to disappear. It is going down against the, kind of equity within the home, but that assumes that $500,000 is the value of the home and it's appreciating moving forward, right? So if you're thinking, hey, I've already got, the house is only worth $450,000, again, that is one appraiser's opinion on one day based upon what some other properties that just recently sold. And maybe there was one that was low and that really killed, the overall kind of local market, and the bigger picture, yes, it's absolutely worth it. There's plenty of times that it might be worth it. I'd love to hear from you. What are your thoughts in this scenario? First of all, $400,000 list price and somebody's paying $500K, that's just nutty already, but that is the reality of where we're at in this market. And second of all, would you pay extra to be able to close the transaction? If it's the perfect home in the right spot or whatever it may be, would you be willing to put more money in? If you've got a very low down payment, extra cash probably isn't an option. So therefore, you would have to go to the seller and renegotiate that. That's why you need a super solid team with your real estate agent, your lender, and potentially attorney. And depending on what state you may be looking in, Illinois, we use attorneys. Over in Indiana, where I grew up, they do not. So you need to have a super strong team to be able to kind of renegotiate in those scenarios. And you also need to have a lender that's giving the heads up of like, hey, I'm looking at this, and based upon what I'm seeing, this might not appraise. Here's some options if it doesn't. We can run through them together. Put your comments below. Thanks so much for tuning in. My name is Ryan Skaggs, The Mortgage Minute. Stay safe, and we'll see each other again very, very soon.